Well, good morning all. Let's crack on. We've still got some more people to come in as attendees, but I think we need to begin. We're on relatively tight deadlines. So welcome to the Alquity webinar, key themes for emerging markets in 2022. I'm sure we'll reflect on 2021 as well. My name is Alex Boggis. I am the head of UK business development for Alquity. Many of you will have suffered me by now, probably by Zoom and probably more than once in the last year, but we have had a lot to say, and increasingly face-to-face, and I hope to be coming out to see you more and more, especially if the weather remains this good. If you're calling in from Europe, welcome. I'm delighted that Mark Rugel has now joined us. He joined at the end of last month, and Mark will be in contact soon if he hasn't been so already, and I know he looks forward to seeing you soon. Logistics, not many. Questions and answers. You should have a bar or some sort of button that you can see. Please send them through at any time. I will be looking at those while the presenters speak, trying to order them and prioritize them and get them answered at the end. The end, by the way, should be around 45 to 50 minutes. Let's see how many questions we have. Now, moving on to the presenters today. Mike Sell will lead the presentation in terms of the content today. Most of you will know Mike quite well. He's been with us since about 2014 and has over 25 years experience in emerging markets. And he's joined by his now two long-term colleagues, Kieran Kader and Dan Billis. Now the team has got a lot to get through. I know you guys don't really want to listen to sales guys, but I will just say before I hand over to Dan that the team has made my job much easier in the last year. They've had fantastic absolute return performance, but also very strong risk return performance due to the changes that we made to the investment process last year, where we gave a tweak here or there that most of you will already know about. So I'm really looking forward to hearing what they have to say today. I hope you enjoy this too. I'll speak to you at the end. Over to you, Dan.
Thank you, Alex, and thank you everyone for joining. So today we're going to be discussing some of the key themes for emerging markets in 2022. We'll start by looking at what the current backdrop for EM looks like, moving on to discussing some of the winners and losers from higher commodities prices. We'll talk about China and India in some more detail and explain some of the divergences we're seeing in those markets today. We'll also be discussing climate change and what we are doing here at Alquity in our portfolios. We'll move on to Alquity's key differentiators and some of the themes that we incorporate into the funds. We'll also be talking about the fund positioning, performance, and finally, we'll finish with a conclusion and a question and answer session. So, kicking off with the first slide. We believe that the global backdrop for emerging markets remains very favorable today. The chart below, on the blue line, it shows the US 10-year yield. The red line showing the 5-year inflation expectations, and the green line showing the real yield going back to 2008. And we've actually been in a period of negative real interest rates for some time now, since the second half of 2019, which is typically a very favorable environment for emerging markets as investors search for riskier asset classes and hunt for yield. Furthermore, the recent Jackson Hole symposium also supports our view. The Fed made it very clear that they will be progressing with a gradual tapering and that a rate hike is not in the pipeline before 2023. On the next slide, we can see that there's actually a very strong relative valuation argument for emerging markets as well. The chart below shows emerging markets relative to developed markets on a trailing price to book basis since 2014. And you can see that EM is actually more than 2 standard deviations below the average. On the next slide, we can present this in a slightly different way on a longer time horizon. So this chart goes back 35 years and shows EM equities versus the S&P 500 on a relative price to book basis. Now you can see that we are actually much below the Lehman Brothers crisis since 2008. And in fact, we're actually approaching levels we haven't seen since LTCM and 9/11 as well, all of which we believe is just fundamentally unjustified, given the strong tailwinds for emerging markets, but also because US growth will likely slow when their stimulus runs out. So moving on to commodities now, I'm going to be discussing some of the winners and losers from high commodities prices. Now, the chart below shows a number of commodities. The blue line represents copper, orange is coal, and green is the Baltic Dry Index, which is effectively shipping freight rates. Now, it might be difficult to tell on this chart, but all of these commodities have run up quite hard. And in fact, even the last 12 months, copper has appreciated 43%, WTI crude is up 56%, and steel is up 53%. So yes, commodity prices have moved, but we believe that higher commodity prices are actually here to stay for a number of reasons, which we'll discuss on the next slide. So firstly, we're not concerned about a growth hiccup. The left-hand side of the table shows GDP growth forecasts for a number of countries. And as you can see, the very robust growth forecasts for China, India, and developed markets. So an improving global growth outlook is particularly supportive for the demand side of commodities. But there are also a number of other tailwinds to consider as well. So firstly, you can see globally a number of large infrastructure plans being rolled out, namely Biden's $1 trillion infrastructure plan in the United States, Modi's $1.4 trillion infrastructure plan in India. And this is very supportive for all commodities used for construction activities, such as steel and copper. Secondly, the Chinese are pausing their monetary tightening. And this is particularly supportive for commodities, given that the Chinese are the largest importer of commodities by a significant manner. And finally, we're seeing a structural shift globally towards electrification, renewables, and a shift towards electric vehicles. And just to give you a sense of just how much more copper an EV uses, in a standard battery-powered EV, it will typically use 183 pounds of copper versus just 51 pounds for a standard combustion engine. And with that, I'll hand you over to my colleague, Mike Sell, to discuss some of the stock specifics.
Thanks, Dan. So as you can see, we remain selectively positive on commodities as we enter 2022. Now, at that stock level, we continue to like Pacific Basin, which is a bulk freight shipper based in Hong Kong, Antofagasta, which is a copper company. We were very early in identifying the very favorable demand-supply dynamics in copper that will last for many years, given the shift to electrification and electric vehicles, as Dan just mentioned. And in South Africa, Anglo-American Platinum. The use of catalytic converters is positive for demand for platinum, palladium, and rhodium. We obviously have cyclical tailwinds as we come out of a COVID recession. But as we move towards a hydrogen-based economy, or move in that direction, certainly, then again, platinum as part of the catalytic process becomes increasingly important for that as well. At a country level, Chile and Peru are highly dependent on metal exports. Almost 50% of their GDP comes from these areas, particularly copper. And that's been masked by the political instability that we've seen there recently. And so we found some really attractively valued companies that are going to benefit from these trends. Of course, it's not all positive. And the dramatic increase in coal prices that Dan just outlined is very negative for maple leaf cement in Pakistan, as they are not able to pass that cost increase on fully. And therefore, we've exited that position due to those reasons. Now, whenever we talk about oil or commodities, India always comes up in the conversation. And the answer now is it's okay for India at this kind of level with an oil price of $60 to $80. In the first quarter, India's current account surplus was 0.9%. That's a surplus. A $10 change in the oil price only has a 0.4% impact on that. Foreign exchange reserves are incredibly healthy at $620 billion. And whilst we're expecting a domestic-driven recovery, as we'll talk about shortly, but Modi's Made in India plans, which will result in greater exports of manufacturing and reduced imports, is already beginning to have an effect at the corporate level, even though we can't see that in the macro data yet. And that can only help further. So now let's delve into one of these markets in a little bit more detail on the next slide, and where we've spotlighted Saudi Arabia. Saudi Arabia is ignored by many of our peers, unfortunately. It's a relatively new addition to emerging markets, and our peers are perhaps not as flexible as we are in seeking out new opportunities for alpha. It also has much better ESG than that traditional oil proxy of Russia. In our process, we rule out 70% of Russian names for ESG reasons. In Saudi Arabia, it's 29%. Saudi has a population of 34.8 million people, which is growing very fast, and this is probably not well appreciated. The chart on the left shows population growth over the last 5 years, and Saudi Arabia is almost growing at 2%, slightly less than Egypt, but growing much faster than those traditional fast-growing countries that everyone knows of Bangladesh, India, Indonesia. So it's growing really quickly, and it has a young population. The average age in Saudi is 31.8 versus 40.4 in the UK or 43.1 in Switzerland. So it's a relatively young population. They've got their act together quite well with COVID, and 64% of the population have been vaccinated with 1 dose at the moment. So we see cyclical tailwinds as oil is 24% of GDP, as well as structural growth from the rapid increases in population and the structural change that people no longer want to live with their parents. They want a house of themselves, as we've seen elsewhere in Asia. And so these structural drivers are an important growth dynamic for the country. And we own positions in the banking sector and in the property sector. I'd now like to pass over to Kieran to talk about China and India.
Thanks, Mike. So starting with the Chinese regulatory environment, it's clear that the regulation to date has been quite aggressive, fast-paced, and taken many investors by surprise. The pace of regulation, however, has since slowed down recently, and for some companies, the rulings have been much less harsh than expected, and perhaps the fear was overdone. We've been using this opportunity to add to some very high quality names like Tencent, where the worst may be over and valuations remain depressed. So there's room to be selectively positive where the fears were overdone. That said, we believe that there is still more regulation to come, but in other avenues. And so the latest idea that is being promoted by the state is that of common prosperity. China appears keen to mitigate the issue of social inequality seen in many countries. It's likely that we will see high net worth individuals and large firms donate resources to social causes, as we've already seen with the likes of Tencent and Alibaba. And in addition, it's likely we'll see higher taxes for the rich, and particularly the ultra rich. Secondly, there's likely to be a focus on revitalizing the lower tier cities and rural areas. In particular, we would expect to see a gradual shift of focus on infrastructure towards these areas, and this would be positive for our holding in Shimao, a Chinese property developer with some exposure to those mentioned areas. And lastly, we expect to see continued support for businesses linked to healthcare, as well as green energy as China strives towards its environmental targets. These trends will benefit our holdings in Wuxi Aptec, a leading biotech and research firm, as well as Zhongsheng, an auto dealer with commanding market share and has partnerships with all the major Chinese electric vehicle companies. In addition, we do continue to evaluate various green energy sectors, but we believe that some of the well-known companies that are owned by peers are either poorly governed or have stretched valuations, considering the unattractive oversupply dynamics. Moving on to India on the next slide, we see a very, very different picture. The chart shows the domestic retail monthly inflows to Indian equities. And it's amazing to see how consistently positive retail inflows have been towards equities. This has been driven by the increase in availability of equity products, as well as low or negative real interest rates, both of which have been positive for inflows in the market. But in addition, with regards to foreign flows, we're also seeing significant interest from all investors, as India has become a more mainstream destination of funds. In fact, we have seen this in our own fund, Alquity India. This has seen significant inflows over recent quarters. And lastly, real rates remain negative, and we expect this to be the case going forwards. And this is a really strong boost for equity inflows, but combined with the strong fundamentals as well, we remain positive for this market. Back to Mike to talk about the monsoons.
Thanks, Kieran. And so on the next slide, we talk about the monsoon, slide number 15. Here, monsoons overall this year have been a little bit below normal, about 9% below the long run average. But as you can see on the right-hand side, that weakness in monsoons is very concentrated in the periphery of India, those areas highlighted in the red. The vast majority of India has had good or very good monsoons, which is the green and the blue areas. And the weather forecast for September also is quite positive, so we expect that to improve a bit further before the end of the season. So we're not worried about that at all. Crop sowing is down 1.8% year on year. Now that is off last year's multi-year high base. So in any other year, the crop sowing this year would be a record. So the rural economy is doing very well, and that's been confirmed by our conversations with over 30 companies in recent weeks, where they and we are expecting a very strong festival season in October and November, and we've positioned our portfolios accordingly. So now moving on to something else that's very topical as we go into the latter part of the year, which is the COP26 UN Climate Change Conference, which is being held in Glasgow in November. And on the next slide here, you can see the carbon emissions from China, the blue line, the US, the green line, and India, the purple line at the bottom. And China overtook the States a number of years ago, and India is fast approaching. Thus, any measures on climate change absolutely have to take account of emerging markets and particularly Asia. And if they don't, then we'll all fail in our goals, as Asia accounts for 45% of global GHG emissions. But encouragingly, we are seeing changes. President Xi in China targets carbon neutrality by 2060. This is a change over the last 12, 18 months. And that's enabled us to have much better conversations and engagements with Chinese companies about their targets and what they're doing to meet them. India doesn't yet have a target, and the rumor is they're considering a net zero target by 2047 or 2050. And it's possible that they could announce something at the upcoming COP26 event. That would clearly be hugely positive for this. Now, we're doing our part. In Alquity Future World, our greenhouse gases have declined from 561.8 tons per $1 million of revenue to 363.8 over the last 6 months, and a similar decline in the Asia Fund. We have more to do here, and this is an area of focus for us. But we're taking action in other areas too on the next slide. As many of you know, we have key progress indicators that act as part of our engagement for every company that we invest in. And we have continued to enhance and add to these over the last year. So we've wanted our companies to have plans to reduce their environmental impact. And we've beefed up this KPI to include greater granularity, for example, ensuring they're science-based targets and they incorporate net carbon targeting by 2050 or earlier. We've added a new KPI to deal with the prevention of biodiversity loss that should be in companies' strategic plans. And we want companies to report in line with the Task Force on Climate-Related Financial Disclosure, which is something that we're going to engage on all these points over the coming months. In addition, we have the Alquity Principles of Governance, which guide our voting at AGMs. And one thing that we perhaps haven't mentioned much in the past, but has been in place for well over a year now, is that gender diversity is a particular focus here. So if we have boards where there is no diversity, then we will vote against the entire board. It is not acceptable in this day and age to have all male boards. And if countries such as India can make sure that doesn't happen, then we don't see why any emerging market cannot have a more diverse board going forward. And so we focus on that in our voting. And finally, we engage on a number of topics and share best practice. Following the note we wrote on the Chinese internet sector last year, we've used that as a basis for engagement with certain companies there. And as particularly Saudi Arabia looks to produce ESG reporting, we've shared some examples of best practice that we've seen elsewhere in emerging markets with them. So now moving on to our differentiators and the upcoming themes for the next 12 months. And on slide 20, you can see where we believe we're very different from our peers and how that helps us to create alpha. So firstly, we have an ESG and an impact focus in our portfolios. Many of our peers have one or the other, but very few combine the two. And we think this is the way that ESG and impact are going, and we continue to be leaders here. And whilst everyone's talking about ESG these days, we're again different as that our ESG process is certified. The label ISR, that little blue logo that you can see at the top right, that was in the previous slide as well, is the French certification, which we believe is the industry gold standard. And they come and go through our process every year for 2.5 days. And we've now gone through that process successfully 4 times. So most people who talk about ESG don't go to that level of detail. Secondly, we provide much greater diversification than many of our peers. We have significant positions in smaller markets and in frontier markets. As an example, in the largest 4 markets in Asia, so that's Korea, Taiwan, India, and China, that accounts for 75% of the Alquity Asia Fund. Many of our peers, those 4 markets, account for 95% of their fund, and thus they have no meaningful exposure to a region of 969 million people, the ASEAN region in Asia, and we think they're really missing a trick there. We also have exposure to unrecognized and undervalued small cap exposure, and you can see the value of this on the right-hand side. This shows the performance of our Asian fund over the last 12 months, the red line, the index, MSCI Asia ex Japan, the black line, and then the gray line, the small cap index. And by having small cap exposure in our portfolios has led to one of the reasons why we've outperformed so significantly. We've actually outperformed the small cap index as well, despite that small cap weighting only being about 1/4 of the fund. So it's one of many factors, as you'll see in a moment, but it's something that really differentiates us from our peers and has added value for us. We also have very attractive portfolio characteristics, as you'll see shortly, and that's led to very strong risk-adjusted performance. So again, now let's deep dive in one of the examples of this, which is Indonesia, and I'll hand back to Kieran.
Thanks, Mike. So Indonesia, as Mike said, is one of our differentiators, and it's a market that we think is frequently ignored by investors. So you can see on the chart, foreign investors have actually been aggressively exiting the market from around 2018. But since the start of this year, that's begun to turn, and there are some developments which have led to a change in attitude towards the market. Historically, interest was primarily driven by valuations and commodities. But earlier this year, Indonesia had its first unicorn tech listing, Bukalapak, which is an e-commerce company. The IPO was very well received by both foreign and domestic investors, and there are also more tech unicorn listings in the pipeline, one of which is speculated to list at a market cap of over $50 billion US. Interestingly, a strong commodity environment has been historically positive for the Indonesian market, but as you'll see on the next slide, valuations haven't really reflected this. In addition, the Omnibus Law will simplify 79 existing labor and taxation laws, which will create a more conducive environment for businesses. And this reform seems to have been forgotten, but it will encourage FDI and will improve Indonesia's medium-term economic prospects. And on the next slide, you can see a chart of the valuation profile on a trailing price to book basis for Indonesia versus Korea. And you can see how wide the valuation gap has become, but has recently started to turn at the beginning of this year. Now, many of our peers have full weightings in Korea. We don't. We have issues with the governance of many companies, and some of the more common stocks have very expensive valuations. On the other hand, Indonesia is very much ignored. There's positive fundamentals and cheap valuations. So all of this leads us to have a large, high conviction and really out of consensus position on Indonesia. And due to some of these smaller markets like Indonesia, as well as some smaller cap stocks that are often ignored by peers, we're actually able to construct a portfolio with some really attractive characteristics. And on the next slide, you can see a snapshot of our portfolio attributes versus the index. We are cheaper, but have better profitability than the index. So the table on the left-hand side shows Alquity's Asia Fund portfolio characteristics. And in 2021, we have a PE of 24.4 versus the index of 28.1. We also have a return on equity of 21.3% versus the index of just 16.7. And in 22 and 2023, again, we are substantially cheaper, but with a meaningfully higher ROE. And similar trends exist for the Alquity Future World Fund on the right-hand side. So back to Mike.
Thank you very much, Kieran. So on to the next slide. Let's talk about the themes that we see for the next 12 months. So firstly, domestic growth. This has always been the key theme across our funds, and it currently accounts for 70% of Alquity Asia and Future World and around 80% of Alquity India. So what do we mean by that? Well, companies that benefit from urbanization, demographics, whether that's a young population, as we saw in Saudi or in India, or an aging population, as we see in China, where we own positions in the insurance sector, for example. Then the shift from the informal to the formal economy. Again, India, Pakistan, Bangladesh. Then the shift from the physical to the digital world in perhaps some of the more advanced emerging markets, such as cacao in Korea, as well as decarbonization and Century Iron and Steel in Taiwan, which makes the bottom bit of offshore wind turbines, would be an example of that. We find both China and India both potentially interesting at this point. China, we believe the worst is over and more than discounted in terms of regulatory risk, and we see a strong economic growth. In India, growth again will be positive post the monsoons, and it will continue to be a beneficiary of foreign fund flows. As Dan talked about at the start, we have a positive global economic backdrop, and that's good for commodity rated stocks and countries, as I mentioned earlier. And of course, we continue to like companies with sustainable global competitive advantages. We don't believe the tech hardware cycle is over and continue to have positions in Taiwan Semi, MediaTek, and SK Hynix, to name just a few. So now let's move on to looking at the political horizon for 2022. So firstly, the US Fed Chair, Mr. Powell, his mandate expires in February. We're not expecting any major changes to Fed policy here, but it's something to be aware of and to keep an eye out on. In India, we have Uttar Pradesh elections in February or March. That is a state that has 200 million people. It's the Hindi heartland, Modi's voter base. He should win again. We need to keep an eye on the resurgence of the farmer demonstrations, but our base case is Modi wins. Slightly more controversially, perhaps, we have the Brazilian presidential election in October. That looks like at this point, it will be between the incumbent, Bolsonaro, and Lula, who's a previous president who's been jailed for corruption. So two highly polarizing candidates. And we expect that to create some volatility in that market as we approach October next year. And equally in October, we have the Chinese National Party Congress, where President Xi will be seeking an unprecedented third term. Again, something that we need to keep an eye on as we approach. So now, having talked about our themes and our views, let's move on very briefly to talk about the positioning of the funds on slide 27. On the left-hand side is the Alquity Future World Fund. And my key point to make here is it's a very diversified fund. There are 20 countries represented there. And many of our peers are overly concentrated in a few, whereas we have positions in Peru, Vietnam, Morocco, Egypt, Pakistan, etc. So highly diversified. Asia on the right-hand side is similar. We have, as I mentioned before, a much greater weighting to the smaller markets, such as Indonesia, the Philippines, as well as the frontiers such as Vietnam, Bangladesh, and Pakistan. We deliberately reduced the weighting of the frontier markets over the last year, and this is the lowest we've ever had for those of you who've been invested with us for a long time. And we expect to increase that again as we move into next year. On the next slide, you can see our top 10 holdings for each of our three funds here. Firstly, I will make no apology for having TSMC and Tencent as our largest two holdings in Future World and Asia, as do many of our peers, as I'm fully aware. Where there are large cap names that we see attractive valuations, we're ahead of consensus, that we believe will be significant alpha generators for the portfolio, we absolutely will own them. Our differentiation comes from elsewhere. So take the Future World Fund on the left. Saudi British Bank is in the top 10. Pacific Basin Shipping, the Hong Kong shipper that I mentioned, Chinese insurance company, Indian Cement. These are not names that you typically see in our peers, and the Asian fund is very similar. On the Indian fund on the right-hand side, again, Infosys and HDFC, we have, as do many of our peers. And our differentiation comes from some of the other names towards the bottom. And it must be noted that we've deliberately taken profits in some of the smaller cap names and rotated into these larger names that I mentioned over the last few months, given the valuation anomaly that we've seen in them. But let's look at the bottom. So Amrutanjan there, which is 3.7% of the fund at this point. This is a company that we bought nearly 3 years ago at a share price of 275 rupees. It's now at 715 rupees. When we bought it, it had a market cap of $100 million. Most of our peers don't look at companies anywhere near this small, but we do, and it's a consistent source of alpha generation, even though it's not covered by any sell-side brokers. Other names there, such as Hero, Escorts, and the cement names, means we're positioned very well for that rural-based economic revival that we're seeing as we come out of the monsoon period. So now moving on to performance on the next slides. Sticking with India, our Indian fund has continued to deliver. So myself and the team who are presenting today are the #1 team on the Citywire rankings over the last 12 months to the end of July. That's the latest data available. So we're obviously pleased with that. And on the sustainability front, we have 5 globes, the maximum from Morningstar for our Indian fund as well. Moving on to Asia and Future World. Again, as Alex alluded to at the start, our process enhancements with Marnie and Sin really helping us with our portfolio construction and an enhanced risk process has delivered great results. So Alquity Asia, so there's a typo there, Alquity Asia has outperformed in 10 of the last 12 months, and Alquity Future World in 9 of the last 12 months. So both Asia and Future World have outperformed very, very consistently month after month. Alquity Asia is ranked 13 out of 180 funds over the last year to the end of July, but August again was very good by CityWire. And Future World just at the bottom of the first quartile there as well. And again, with a very strong August after that. So what's driven this performance? Well, it's been very diversified. We're not a one-trick pony. We don't have all our horses in one place. So Pacific Basin, the Chinese shipper, Chinese auto dealers. I think that's a source of alpha that none of our peers have had. Then in the tech space, Korean, Brazilian, and Singaporean internet companies have added value for us. Indian small caps, Pakistani cement also. So we have delivered alpha from both small and large cap names, from frontiers and large markets, and value and growth stocks. And that's what we're most pleased about over the last year. On the next slide, you can see our volatility profile. And starting with Asia on the left, 3 years to the end of July, we were 163 over 168, i.e. we had one of the worst, most volatile performance profiles of the peer group. But the work we've done has meant that that's come in dramatically. Much better alpha, as I've just shown you, versus the peer group as well, with much lower volatility, 60 out of 180, despite being very different from the index. And again, a similar story with the Future World Fund on the right-hand side. So now, just concluding before we move on to the Q&A session. On the next slide, you can see that growth tailwinds are expected to persist in our view, and emerging markets are just clearly cheap for the work and the slides that we've shown you previously. As we move into 2022, we believe smaller markets will come to the fore. You already saw that happening in August with big moves in markets like the Philippines, and we expect that to continue after a poor period of performance. Domestic growth will be the key driver of markets. We find both China and India attractive at the moment. Commodities will continue to do well, both at the macro and at the stock level. And decarbonisation and COP26 will be increasing themes as well as we move into next year. So finally, we'll end with that our differentiation and our enhanced process has delivered stronger returns with lower volatility, despite incredibly challenging market conditions. So thank you very much. And Alex, I'd like to turn over to you for the Q&A session.
Yeah, thank you, Mike. Thank you, team, for that. A number of questions have come through. In the spirit of us being ESG managers and genuine ESG managers, I think I'll start with at least one ESG question. And the first question is a good one. So do you fear that countries are all jumping on the bandwagon with these long-term carbon forecasts in the knowledge that the current governments are likely not to be accountable for what they say or for what they say they're going to do as administrations change, and therefore so will priorities? So are current governments just jumping on the bandwagon to say what they think people want to hear?
That's a great question. Interestingly, when it comes to somewhere like China, which is probably the biggest single driver, then no, I don't think that does apply. If the Chinese government says something, then they will do it. And President Xi is going to be around for a while. It's a very top-down, command-driven economy in many ways. So in that case, I think that premise is not correct. And as I said in the presentation, some of the moves that we've seen at the corporate level are really buying into that top-down philosophy. Elsewhere, there's a risk of that, but that's why we buy companies whose cultures are aligned with this, rather than buying countries where governments elsewhere may change.
Okay, thanks. I'll jump around a bit. I'll go to a more big picture question. So how do we manage FX with exposure across so many countries? I guess, how do we also think about it?
Sure. So where we become concerned about a country through the macro analysis that we do as a team, then we would not own that country if we felt that the FX was going to cause a destruction of performance. And so Malaysia has been an example of that for a very long time, where we've been concerned about the outlook for that country, both economically and politically, and we've not owned anything. Now, clearly, sometimes in a weak currency environment, you might want to own exporters. And so we obviously could do that. But in Malaysia, there was nothing at all that was attractive. But more generally, to answer the question, we do a deep dive on the countries. We do that very regularly. And that's how we come up with our view on GDP, interest rates, as well as FX.
Okay, thank you. There's a question about stock valuations. I think you touched on this to some degree, but I'll ask the question. How do we assess stock valuations across EM, considering some of the recent stock market performance? And there's a part B to that question. So how do we evaluate the stock valuations? Why are PEs within the portfolio over 20 times when you suggest that valuations look so attractive on a historical basis? Sorry, I've doubled up on you there.
Sure, that's absolutely fine. So we're very fundamental in our analysis. And so for every stock that we invest in, we do our own analysis, both from an ESG perspective, but also from a financial perspective. So our own balance sheet, cash flow, P&L, we compare our forecasts versus consensus. We have DCF-based valuations, as well as looking at peer PEs, whether that's in the country, in the sector, or more globally. So that's where we see attractive opportunities. Now, in terms of the PE for the fund as a whole, yes, it's a big number, but our point was that the index, which is Asia overall, is more expensive. So firstly, you're coming off a period of low earnings given COVID. And secondly, the return on equity that we provide is much higher than you would get from buying an ETF or from the index, combined with obviously a higher quality portfolio given the ESG, but with cheaper valuations than you'd again get from the ETF or an index hugger peer.
Thanks, Mike. So there's quite a lot of questions coming now. I feel a bit ambushed at the end of the day, but I will go back to more ESG type matters. COP21 delivered the Paris Agreement. It seems we're in a wholly different and more positive place now. Can COP26 deliver something as big for how climate change is managed and investments are targeted?
Good question. And I don't have a crystal ball. I think the way we think about it is it just going to be the Western countries coming up with solutions, or are the emerging countries going to be a part of that? And given the very different states of development that the countries are in, then it's going to be tough. Now, China, Taiwan, Korea have come up with commitments. India, the big one, hasn't. And there are some other big emerging markets, not as big as India, who haven't as well. So I think time will tell. It's clearly positive that the mood music from America has changed dramatically. That can only help. And the EU and the UK clearly are very much on board for this as well. So I think the thing to look for will be the breadth of inclusivity. And India is the big outlier. If they join up into some sort of targets, then I think that's hugely positive news. But we'll have to wait and see till Glasgow in November.
Okay, thanks, Mike. I see a question has also sneaked in on the chat. So there's a couple of avenues of questions, but can I ask a couple of specific questions about countries? Very specific, this one. So reference China. How does Alquity view the situation regarding the troubles of China Evergrande, which is China's biggest property developer? Will there be a significant flow-on effect if it goes bust, e.g. a drop in demand for commodities, steel, copper, etc.? So I've got a question about property and commodities in one, and China.
Sure, I'll start, then I'll hand over to Kieran, who...
I've lost you there, Mike. I'm not sure if everyone else has lost you.
more is this overhang from Evergrande. So to tackle the second part of the question, the reason
Mike,
we
can
like
you start the answer
property
again? Because we lost you on the first 30 seconds.
Oh, I'm sorry. So we're overweight Chinese property, and the reason we're not more overweight is the overhang from Evergrande. Now, why are we overweight Chinese property? That goes back to our long-term themes: urbanization, demographics. You have long-term drivers for property, and whether it's Evergrande or the companies that we own, like Shamal or CR Land, people need and want to own housing to live in. And that's absolutely key. So in terms of commodities, no, I don't think it does have an impact, because if Evergrande falls, then it will shift to other companies that are better run. But I'll let Kieran add to this as well.
Yeah, thanks, Mike. And I think it's a really good question. So actually, I think the negative impact from Evergrande falling wouldn't be as much on the commodity side, rather the financial side. So Chinese banks, namely, have very large positions in the Evergrande bonds. And so we would expect those to be the first to see sort of major write-downs and volatility. We own zero in Chinese banks, and we have a little bit in Chinese life insurance companies, but they are the highest quality ones. So that would be the immediate impact. I would say that overall, we still maintain the position in Chinese property as well, is that we don't believe that Evergrande will fall. And there's a few reasons for that. Firstly, that Evergrande does have assets that it can sell. So they have several unrelated subsidiaries, things involved in electric vehicles, etc. And that amounts to around 300 billion RMB. Secondly, they have still a lot of land bank and saleable resources. And so if they could still sell it directly to customers, or they could sell it indirectly via other developers. And there's really no shortage of demand there. And so to date, we've already seen Evergrande reduce their debt significantly, but there is more to do. And perhaps lastly, it's unlikely that we would see Evergrande fall, just because it is so large. And that we've seen that the state is, their desire is to smooth the bumps as opposed to allowing, huge negative shocks to the economy. So to that point, we would say that overall it seems unlikely, but it's of course something that we monitor closely. Thanks very much,
Kieran. This looks like a tough question to me, but I'm going to ask it. Pleasure. What would be the sector-adjusted price-to-book value discount of emerging markets versus developed markets?
Yeah, interesting question. I don't have an exact number for you off the top of my head, but actually it's going to be very, very similar. The composition of emerging markets has changed dramatically over the last couple of years. And IT, which is obviously the high PE sector, is pretty similar. So in developed markets, IT represents 22.8% of that index. And for emerging, it's 21.3%. So there's really not a lot in it. Now, emerging has a bit more commodities, a bit more financials, but the principle's the same. Emerging's moved on, and tech is a big part of it now, so it doesn't alter the thesis really at all.
All right, thank you. Maybe one or two questions, because we're getting near what we projected to be the end. The majority of attendees are still here, so I'll push on a little bit. You can show your displeasure by leaving, but please don't. Why do you choose to stay away from fintech? Do you do that? A strong trend in Asia, still at an early stage, so plenty to benefit from and several IPOs coming to the market across all your markets. So your views on
So we do have exposure to fintech, but it tends to be through a broader company. So Kakao has Kakao Pay. SEA also has a fintech arm. We don't have any dedicated specific exposure. We haven't found a company that meets our criteria from an ESG and or a financial valuation perspective, but we have no bias against it. One thing I would caution is that although fintech is all very sexy, in some markets, the incumbents also are doing a really, really good job on digital payments as well. So it's not a one-way street, and Indonesia certainly would be an example of that, perhaps. But we do have exposure, but it's in a broader tech grouping like Kakao or SEA.
Right, thank you. So again, another slightly tricky question, possibly, and it alludes to country versus companies, I think. Is it really possible to legitimately claim Saudi Arabia as an improving ESG prospect as a country when it still uses torture as a form of punishment and discriminates against women and bans human rights organizations?
Yeah, it's a good question. So the way we treat ESG at the country level is that we recognize that countries like Saudi, but not the only one. I mean, China clearly up there as well. India has had some very nasty laws coming in to sort of restrict freedom of speech on the internet. Bolsonaro has not been a nice person, neither has Duterte in the Philippines or Turkey. Obviously, Russia is up there as well. So it's not just Saudi. There are issues in many countries. The way we tackle it is that if the governmental macro environment is such that no companies can be run in the interests of their stakeholders, minority shareholders, then we will have absolutely nothing in that country. So when Myanmar, Burma, had the coup a few months ago, clearly in that example, the position that we had could not be run in the interests of minority shareholders, no matter how great the management was or how great the story. And so we immediately exited entirely. Typically, there are companies that are good, are run to Western principles of governance, and we do find attractive. There may not be very many, but typically there are some. So in China, we avoid state-owned companies. We don't have the banks, as Kieran mentioned. We don't have China Mobile. We don't have anything that is run by the government per se. In Russia, corruption is very pervading. And as I mentioned, we rule out 70% of Russian stocks for that reason. In markets like Bangladesh and Pakistan, again, it's quite a high level we rule out. In Saudi, again, we rule out companies that are government run, but we own two companies, both of which are private sector. One is the leading property company, benefiting from the themes. Management are very aligned with minority shareholders. And the second is a bank whose parent is a Western bank and subscribes to Western principles of governance. So the issues that you think of don't tend to apply to those areas, but it's something we're very alive to. But hopefully that explains how we treat it and when we've made changes in the portfolio for exactly that reason.
Yeah, very good. Thank you very much, Mike. Look, I'm going to draw this to a close. There are a couple more questions and they've got names on them, so we can send you answers back directly. Thank you very much, all of you, for attending. Thank you very much for the presentation.